Welcome to the Weekly Look Ahead, where we take a look at gold, dollar, a couple exchanges, and Bitcoin. Also, make sure to like and subscribe so you get these updates as they're released. Now let's look ahead. Hello everyone, this is the Look Ahead, the Weekly Look Ahead for the week of April 7th, 2025. So we're going to be looking at the weekly charts. This is where we look and see what has happened last week, what's happening this week. Markets have opened up considerably down for this week, but we're going to see how this is going to pan out moving forward. So here we have gold, and it's a weekly chart. You see the channel line in gold, and we're going to move in now on gold, and we're going to look at previous weeks and then this open of this week. So we've opened up considerably down, but previously week we kind of had to push through a rise up, and we had this coming back and retesting this channel. But now it's starting to break through the channel, and it's starting to look like it's getting ready to pull back further. So we've already had a significant pullback at open, and I believe that this will continue down and that we'll have a continuous down move in gold for right now because markets are selling off. People are liquidating secure assets to cover margins and things like that. I've kind of gone over this before. And gold is one of those assets that you're going to be liquidating. So we're going to see gold continue to the downside. It may hold at the level it's dropped to on open here. It's sitting at about let's see where that's at. It's about 29 and some change. So it may fluctuate in there and maybe come down here to about 29.40. So I would definitely look for a continuation downside this week in gold. Dixie, again, it pulled back. It's pushing down. Again, I am looking for this to make a move this week down to about 100.4. So 140. I'm sorry, 100.40. And that's where I'm looking for Dixie to come to this week. Now, this is very interesting because in a situation like we're in, you will generally see dollar move down. It will move down until a certain point, and then dollar will start to be collected. Now, when does this happen? This happens when interest rates start to go down. And there's a high probability that the Fed is now going to lower interest rates because of the market starting to head in a downward direction. And so this being the case, treasuries become more valuable. And so people must have dollars to buy treasuries. And so now you start to have an outreach towards treasuries, and you need dollars. So you're starting to cash in everything to get dollars. Dollars become more scarce because more people need them to buy treasuries. And you have the dollar start to do this. It goes down and then it starts to rise. And that's what we're looking for. And we're looking for dollar to make a beautiful rise up to 109.03 in the coming months. But next week, we're just looking for dollar to continue down. Maybe it gets all the way to the 104.40 spot. I'm not sure, but we're looking for any pullback in dollar to be a short this week coming up. In NASDAQ, here's our current weekly channel. So again, we're looking for continuation to the downside to about 15 to 23. Okay. So this is a pretty aggressive move down. Is it overplayed? I think so. I think it's a little overplayed. Obviously, there has to be, because of the tariffs, there has to be a lot of adjustments that are going to happen. It's going to be possibly very expensive for some businesses, and it's going to put more, cause things to increase in price, which is going to cause people to buy less, which will wind down the economy. Okay. Now, this is part of the plan because we have to refinance our debt, and financing at the rates that we're at now would be very expensive. So if we bring the economy down and we have low interest rates when we go to refinance the debt, we'll be able to refinance it at a lesser amount, which will save us a lot of money in the long run. So it's kind of a plan move down to help us get the Fed to react and lower rates. And that's pretty much the concept behind it. So how much does this affect other people? Well, the 8% of the country owns the majority of stocks. And what happens is when you have something like this. Does it have a direct effect on business? Well, yes and no. It has a large effect on the large businesses. And we had the Magnificent Seven in the S&P, and so it has a large effect on those. They employ a ton of people. So yes, you could see some layoffs, but you have small business, which is the majority of the employment part of our United States, and that should benefit from this. So it's kind of a tit for tat. You may see in job numbers, you may see some job numbers, you may see sometimes it increasing, sometimes it's decreasing. That's because you're having that kind of, well, maybe large companies will be laying off, but small companies are hiring at the same time. And so you're going to see that difference in job numbers. And that's kind of what we saw this last job numbers. Now, I don't put a lot of faith in job numbers that come out because of the way they're calculated. But based upon what we saw, you definitely know that government jobs are reducing, which is good. And middle America jobs are increasing, which is good. Okay. And we have more productivity. Now, a lot of people will say, well, let's just keep feeding money, tax money, and let's keep borrowing money and feeding it and, keep having an explosive economy that way. Well, that's kind of like sugar. It will last for so long. Once that energy runs out, it's gone. There's no real strong base energy like good fat to come in and make up the difference. And then you really have a mega crash and it really wipes out everything. This, I would say, is more of a control crash. I would personally think it'd be good that we have somewhat of a mega crash because we've never cleaned out the zombies out of the financial system. And that would definitely do it. That would clean out all the weak companies that were just hanging on and through bad debt and so forth. It would pretty much clean that up and we could start afresh with companies that are going to be really strong, bring job growth, bring economic growth, bring strong GDP to the country. We kind of really need a reset. We really never had that after the GFC. We just kind of band-aided it and hobbled along, but we've never really corrected the underlying issues in the financial system. And a lot of that has to deal with debt and dollar. But again, we're looking at the NASDAQ to continue to downside. Again, my target is somewhere in the neighborhood of about 15,450, somewhere in there, until we maybe get a good size bounce. Next, we have the Dow. So the Dow on open has dropped down. It's down to the 200 moving average on the weekly, but I do expect it, even though it's pulling back here now, I do expect it to continue down until we get to about 36.25. And then I expect to bounce in this, but I do in the coming weeks expect for it to roll over and go lower. So we're coming up on bounces here. We may hit those this week, but again, these are the targets down lower and then up if we do get the bounces. Next is Bitcoin. So I was looking for that to break. So if I go down the 4-hour chart, we said it was going to break and it has broken. So we're looking for the retest and the move down. So we're looking for Bitcoin to come down to eventually, may pull back this week, but then it'll start to roll over. But definitely in the coming weeks, we look for a 66,000 target. Looking at a few other charts here, I want to look at emerging markets. So this is iShare Emerging Markets ETF. And what I look for is I look for expansion, contraction, emerging markets, because they really tell you of economic growth or contraction on a global basis. And what I'm seeing here in what I've been watching for a long time is this head and shoulders forming in the emerging markets. So we're expecting a nice swing down, which means contraction in the global marketplace. Now, obviously, these tariffs are going to be the instigator of that, but global markets have been contracting before this. So you see that they reached a high here around 2021, and they've been contracting ever since. And now it looks like they're going to go down to the next leg. But yes, we've had contractions, financial situations in like China, Europe, and other parts of the world have not, Brazil, other parts of the world have not been good. And so now with the tariffs, it's instigating a reset in the global financial picture. And so we're watching that very carefully to see how strong an effect it has, because it will tell us how strong of a risk off market we're going to be experiencing over the next few months. So that's one of the reasons why I look at the emerging markets ETF. Another thing I watch for is copper, and we see copper has finally reached the top of its large weekly channel line and is coming down. Why? Because if development stops globally, copper will start to fall off because we use copper in developing countries. We use it in all sorts of electronics, and most electronics are made outside the United States and other things in buildings and so forth. And all that shows contraction. So we're going to see a contraction in copper. So you could be short copper and be able to trade it as well based upon what we're seeing in contraction. Next, one of the things I really watch for domestically is we have the iShares, and that's it's actually Spiders, and that's the regional banking ETF. Regional banks I look at carefully because they show me weakness in the banking system first. And one of the things I'm concerned about is you see this head and shoulder formation on the regional banks, and it's breaking this channel. So I'm expecting a retest of the channel break, but a continuation down, and this time a break of channel, a retest, and a move further down. Now, what would change this? Again, if the Fed begin to lower rates, this would increase the balance sheet or the value of the balance sheet on the regional banks where they hold bonds. And that would begin to stabilize these regional banks. What has happened is that these regional banks have been caught off guard by the huge rate increase by the Fed, and which has decimated bonds, the value of bonds. And so what's happened is the balance sheet, you need to have that balance sheet even. And if you have things like if you're loaded up with bonds to be the positive side of that balance sheet, and all of a sudden they lose value, you have to go in and you have to buy something else that's going to add value to that side of the balance sheet so you can balance out assets and liabilities on that sheet. Well, if the value of the bonds starts to increase because the Fed begins to lower rates, this could begin to equalize the balance sheet of these regional banks and stabilize them. We'll just have to wait and see if that happens or not, if they can hang on that long. But that's what we're looking for here. If it comes down here, it begins to stabilize. But the structure of this being a head and shoulders, it would mean further swing downside. So at least down to the 27 mark is where we're looking for that to go, and maybe a little further before we would see a recovery, which would be a significant move for the regional bank. And probably, I would dare say, some failures because of that move would be so aggressive. So it's one of the things we watch for. Next, I've been watching the Chinese yuan for a very long time. You see, I've had this all squiggled out for a while, and it's been hanging around here, which I thought it would do for quite some time. And it's starting to make its move upwards. Now, why is that? Because the Chinese manipulate their currency based upon the dollar peg, which they have their currency pegged to. And as we see this new global contraction, it spells danger for the Chinese economy because they still rely heavily upon exporting. And if we have no exporting to other countries because their countries are contracting, and if the U.S. is raising tariffs, then we see the Chinese economy starting to get decimated because they are not having that inflow of capital or of dollars coming into their economy. They've finagled different ways to get dollars into their economy, but now they do not have that capital flow of dollars coming in. It begins to constrict, and that is doomsday for the Chinese economy. So what we are looking at here over the years is that the yuan against the US dollar is getting weaker and weaker, and I expect it to really take off here soon. Now, when that takes off, that creates what we call a contagion in markets, and it would have quite an effect in the US market because we're interconnected with China still. Even though that the pandemic took a lot of that away, or took the first part of it away, we're still interconnected. And when that happens, it creates a contagion not only in Chinese markets, but in U.S. markets because of the business relationship we have with China, with many of our companies. And so this is something to be very watchful of. And once it breaks above this level here, which is about 7.36, I would look for a very strong risk off move in our markets over here on the other side of the pond. So that's something to be keep an eye out for as well. Last thing I'm going to look at is the Japanese yen. And you see, again, there is, well, let me get these out of the way so you can get a better idea what's happening here. There is a definite pullback going on here as we have this head and shoulders formation neckline, and we're looking for this to continue down. So you can trade the Chinese yuan. It's getting stronger simply because the carry trade, people are doing the carry trade, so they're needing yen. Yen therefore becomes stronger, and we see the move starting. So any pullback in dollar yen, look for a continuation of the downside, at least to the 140 spot, and I would say a little bit further from there before we start to see the up move again in the dollar yen pair. But again, if we pull this back, squeeze it up, let me squeeze it up here, we can see the channel there. So let's go ahead and draw that channel in real quick so you can see that. Here's the channel that we're looking at right there. And so we're looking at that channel for now. And the bottom of that channel lands right over here at this support level. So the bottom of the channel we're looking at is that 140 spot right over here. So we expected it to get to that level this week. So watch for continuation to the downside on every pullback is what I'd be looking for. This concludes the outlook for this week. I added a few things in here so you can kind of get an overall understanding of how markets are moving, why they're moving, the expansion contraction of the dollar, the expansion contraction of emerging markets, and what effect they have on our US markets as well, and what effect these tariffs have on these markets as well. So something that you need to be considered when you're entering in your trades. This is something we teach in our level 4, the correlation of markets, and how you can see what one market's doing to determine what another market is going to do next. So kind of like an arbitrage there, but that's what we do. We understand markets. We understand the whys of trading, and that's very important in my book, not just to have the skeleton of technical analysis, but also have the bone, the muscles and everything onto that to have the understanding of why things are happening the way they're happening. And so if you want to be a part of this and learn how to really trade, not just get some indicator or just to get some system, but really learn how to trade the markets in all conditions, I'd encourage you to hit the link below and join us and come find out more about us. It doesn't cost you anything, and you can determine if this is something you want to pursue the way we look at and the way we trade it. Take care. I hope this helps. Have a great week trading. I'll talk to you later.